Advanced Financial Accounting OneNote Practice Problem. In this presentation, we're going to go into a practice problem using OneNote related to a forward contract to manage foreign currency risks from a purchase. Get ready to account with Advanced Financial Accounting. Here we are in OneNote. We're going to go over all the information for the problem first, and then we'll pull out pieces of that information that we can refer back to as we work through the problem. So we have on 12/1/X1 US company, that's us, we're going to be the US company, entered into a 120-day forward contract to purchase Australian dollars, 100,000 Australian dollars. Now we're going to have a few problems that are going to have this similar starting point. So we'll have the similar starting point and then reasons for the forward contract that will change, that will create different scenarios. Then we have the spot rate and forward rate that will be applicable for the applicable dates. Let's go down and look at the data and then go back to these rates once we see the rest of the data. We have the forward contract was to manage the foreign currency risk from the purchase of furniture. 12/1/X1 for 100,000 Australian dollars. We purchased them on account, which is then payable in Australian dollars on 3/31/X2. Forward contract not designated as a hedge. So let's recap that real quick here. We're going to say, all right, we purchased furniture from an Australian company. We purchased it on account, meaning we got the furniture. We're going to say we're going to record it on 12/1/X1, but we're not going to pay for it until 3/31/X2. So we have our normal kind of payable. Notice that's 4 months later. We got December, January, February, March, 4 months later, which is 120 days. So that's going to be 120 days later, we'll make the payment. Not only that, but we're not going to be paying in US dollars. We're going to be paying in Australian dollars. So we're going to owe Australian dollars in the future. Now, because of the fact that when we record our furniture at the point in time that we buy the furniture, and that point in time between then and when we make the payment, 120 days later, there could be a difference in the exchange rate between what we measure dollars as, or what we measure our activity as in dollars, and in what we're going to be paying this thing in, which will be Australian dollars. Therefore, we entered into the forward contract. The forward contract was to manage the foreign currency risk from the purchase of the furniture. Therefore, if we go back up to the forward contract, that we entered into it at the same point. You're thinking about these as two separate things, but we did one because of the other, right? We did one because of the other. Now we have the forward contract that we entered into on 12/1/X2. US company entered into a 120-day, so that's going to be 4 months. So that's going to be basically ending on 3/31/X2, or the time and point in time that we make the payment for the furniture that we bought on account that we're going to be paying in Australian dollars. And that's the forward contract to purchase Australian dollars. So let's see how this will work as we go down. Let's pull in our data here. We're going to say the first thing we're going to do is put the asset on the books just like we normally would if we were to purchase something on account. So the first thing we did is we said we purchased this thing and we purchased it on account. Therefore, we're going to pay for it in the future. We're going to have to value it now, however, even though we're going to pay for it in the future with Australian dollars. So let's go ahead and do that. We're going to do that with the current spot rate. So we're going to use the spot rate. The difference between the spot rate and the forward rate is the spot rate is the exchange rate at this point in time, at this date. We're not actually paying at this point in time, but we're going to use this point in time as the spot rate to value our depreciable asset, what we're purchasing at this time. The forward rate is a speculative rate. You can think of it as a speculative rate, and these speculative rates are all pointing to the same spot, that being 3/31/X2, the point in time that we actually make the payment. So the changes that we have here, the dates that are changing, will be the dates as time passes, always pointing to or aiming at that one end point, that end point being 3/31/X2, the time that we make the payment. So let's go ahead and record this thing. We're going to say we're going to be paying this thing 100,000 Australian dollars times 0.6. We're picking up this 0.6 right here, the spot rate, 60,000. So we're going to put the depreciable asset on the books at what we believe the value of the currency is at this point in time. That's going to be the depreciable asset. We're valuing it now in American dollar, or, in dollars. $60,000 worth of equipment is what we purchased, even though we're going to be paying 100,000 Australian dollars, and we're going to be doing so 4 months from today. So then we have the accounts payable that's going to go on the books, and we're going to note that it's accounts payable in our Australian dollars. basically saying, hey, look, there's in the accounts payable, we're valuing U.S. currency, 60,000 U.S. dollars, worth that we're going to owe, but we're going to have to pay it in Australian dollars. Okay, so what's going to happen in the future, of course, is the depreciable asset's going to be remaining where it's at, but the accounts payable then could vary as the value of the dollar versus the Australian dollars changes between the point in time that we have made this transaction and the point in time that we make the payment of Australian dollars 4 months later. So next, we're going to put on the books the forward contract, recording the forward contract. Now remember, the forward contract is to manage the foreign currency risk from the purchase of the furniture, but we're thinking about them as a separate thing in terms of the journal entries that we'll be putting in place. The dates will line up. We have the same kind of starting date. 120 days later will be the ending date, or the date that we make the payment for the furniture, and that's going to be the same lined up date, but we want to think about these things separately. As we do so, we'll see why basically the forward contract can be used to manage foreign currency risks. So when we put this on the books, what's going to happen is we're going to put a receivable and a payable, an asset and a liability on the books. The asset's going to be called foreign currency receivable from the exchange broker. It's in Australian dollars, meaning we're going to get Australian dollars in the future. The payable is going to be the dollars payable to the exchange broker. It's in dollars, meaning it's not going to change. Basically, we're just going to pay U.S. dollars at the end of the day. Therefore, as the exchange rates change, the foreign currency receivable will fluctuate. Now, it'll fluctuate a little bit differently, as we'll see, than the payable, but you'll see that as the fluctuations happen, we now have a receivable and a payable on the books. And as those two things fluctuate, as the exchange rates strengthen and weaken, they should fluctuate in basically opposite directions, right? So it should kind of act as basically an evening out setup. So let's see what this will look like. Now, the difference here is when we put this on the books, the amount is not going to be the spot rate. The amount is going to be the forward rate. So we're taking the same $100,000. We're thinking about how much it will be worth in the future. We're predicting into the future, and that's going to be at 3/31x2, the end of the contract. And as of December 1st, we believe that the forward rate, or the predicted rate at that point in time, is 0.609. So we're going to take the 100,000 times the 0.609. That's going to give our 60,900. So we have our 60,900 on the debit and credit side here. So we have our receivable now being recorded at the 60,900, and we have our payable being recorded at the 60,900. Once again, as the currencies change, then we're going to make adjustments to the receivable in Australian dollars, the payable, which is in Australian dollars from the last transaction, and we will not be adjusting this payable, which is the dollar payable to the exchange broker. Okay, so the next relevant date that's going to take place is 12/31x1. So on 12/31x1, we have a balance sheet date. Therefore, we have to do adjusting entries to revalue then this receivable and this payable as of the balance sheet dates. Let's take a look at the payable first. So we're going to be considering this payable. Let's go back up to the prior problem. Notice that this column now is including everything that has been entered up until this point. So that includes the prior two transactions and then the current transaction we are on. Obviously, this is the beginning balance as of the beginning of the problem. Now I'm going to go back up to the prior point so we can look at the payable before the transaction was recorded and then think about what's going to happen as of December. So if we look at the payable, we're going to say, all right, the payable is currently on the books before our transaction at 60,000. And now we're going to use the spot rate and say on 12/31 it's 0.610. So we'll take that 100,000 times the 0.610, and that's going to be the 61,000. 61,000 minus 60,000 means we have a $1,000 difference. That $1,000 difference means the payable is going to go up, and it's going to create a loss for us. We have a loss. Why? Because the spot rate was 1 Australian dollars equals 0.6 US dollars. Now 1 Australian dollars equals 0.61 US dollars. So 1 Australian dollars now equals more US dollars. Therefore, the Australian dollars got stronger, and we're going to have to make this payment. This is the liability side in Australian dollars, and we're going to be paying something that is more valuable than it was when we made the contract in the past. Therefore, we have a loss. So we're going to say that the foreign currency loss is going to be the debit, and then the other side is going to be to the accounts payable. So now the accounts payable is going to be on the books at that 61,000, which we calculated here after we record that, and then the foreign currency loss, of course, being on the books as well. Now we're going to do the other side. We're going to say, okay, now we have to think about this receivable. So that's why we have the receivable for the forward contract on the books. We're going to be adjusting the receivable, not the payable, related to the forward contract. So now, and that's why these things should fluctuate in opposite directions generally, even though with the receivable, we're typically going to be using the forward rate. So we have a similar kind of process. Let's go back up to the prior item. This is what was in our receivable before before 1231. Now let's go to our new calculation. Is going to be 100,000 times, and we're going to be picking up the rate, the forward rate now, because we're still predicting as of the new point in time the value that's going to be there as of 331x2 at the end of the contract. So we're going to say that is here times the 0.612. That's going to be the 61.2. So the 61.2 minus, if we say minus the 60,009, that's going to be $300, and that's going to result in a gain. Why? Because it was $1. This is the predicted rate now. $1 for Australian dollars equals 0.609, and now $1 Australian dollars equals 0.612. So $1 Australian dollars equals more dollars. Australian dollars once again got stronger, just like it did with the spot rate, which is kind of like what you would expect generally with a predicted rate versus the spot rate. But this time we're talking about a receivable, meaning we're going to get paid in Australian dollars in this case. And the Australian dollars are now stronger than they were when we originally made the contract. So in this case, that's a good thing. That's why it's there. That's why we have the forward contract, because it should kind of offset to some degree. So we're going to say, all right, now we've got the foreign currency receivable. Exchange broker is going to be the $300 increase in the receivable, and the foreign currency transaction gain will be recorded. So once posted, then now we're at that 61,200. And on the gain side of things, we've now recorded our foreign currency gain. Okay, next thing that's going to happen is on 331. This is when the endpoint happens, right? The endpoint happens where we're going to end up paying off our payable, and the forward contract will end as well. So before we can do those things, we have to revalue once again at this point in time. Now this is at 331x2 the next year. So that means that the prior transaction up here, I took these ending balances. These ending balances are now going to be the beginning balances down here for the year 2. And then all of the equity section, the 100, the 1,000, and the 300 is now in just simply the equity section reflected in retained earnings at the 99.3. So this is basically the post-closing trial balance for year 1. Now ready for year 2, nothing's in the income statement accounts. It's rolled into the equity section. Okay, so now we're going to say that it's 331. Let's think about, we're going to do the same thing for the accounts payable contract that we did at 1231. So we're going to say, all right, this is what it was before in the payable contract. So let's go back up here and let's pick up our rates. So now we're going to be using the 331 rate. So we're going to say 100,000 times the 0.602. That's going to be the 60,200, and what's currently in there, it's going to have to go down. What's currently in there minus the 61,000 is the $800. So $800, and that's going to result in a gain. Why is it a gain? And we're going to have to jump up here to the 1231x1 items. That's where we were before. We didn't do anything on 130x2. So up here on 1231x1, it was at 0.61. So $1 Australian dollars was 0.61 US dollars. Now we're at $1 Australian dollars is 0.602 US dollars. Therefore, the Australian dollar has gotten weaker because $1 Australian dollars is worth less US dollars. And we're talking about a payable. We're going to be paying in Australian dollars. We're going to be paying with something that has gone down in value. So the thing we're actually giving up at that point in time will be worth less, which is good for us because we're giving it up. It's a payable. So that's why we're going to end up with a gain. So we then have the accounts payable is going to be that $800 on the debit side. and that's going to be decreasing the accounts payable. Then we have the gain that's going to be recorded on the books. Now, also note when you record these differences to calculate that 800, you can see it as basically the difference first times, and that's a little bit quicker to calculate. So you could calculate it as 0.602 minus, and then we'll pick up this one, 0.610, and then multiply that times, hold on a second, we're going to take the 0.61 minus the 0.602, and then multiply that times the 100,000, and that's going to give us your 800. So that'll be a little bit faster to calculate. Okay, so next item we're going to have, scroll on down, is going to be related to the same kind of thing, but now with the receivable type of thing. So now we're on the receivable. We're at that ending point at this point in time. So we'll do the same thing. Let's scroll up to where we were before. So we were at this receivable 61,200. Now we're at 331, and we were using the forward rate. We're no longer going to be using the forward rate. There is no forward rate showing here for 331x2. Why? Because we're at that point in time. It is that point in time. We can't have 331x2 and be predicting into the future. It is what it is as of now. We're now at that point in time. So there is no forward or predictive rate. We're just going to be taking the spot rate, which is 100,000, times the 0.602, and that's going to be the 60,200. And if we take that minus the 61,200, we're going to have a difference of $1,000. This is going to be a loss. Why? Because last time we were at the point, we're going up to 1231.612. $1 Australian is 0.612 US. Now $1 Australian is 0.602. So the Australian dollar got weaker. It's worth less US dollars. And in this case, we're going to get paid in Australian dollars. And so we're going to get paid in something that has now gone down in value since that last point. And therefore, we've got this loss. So we're going to say, all right, that's going to be a loss. We're going to record the foreign currency loss, which is going to be a debit on the income statement. The other side is going to go to the foreign currency receivable broker. That's going to be the 100,000 up top, bringing that amount to the 60,200. Notice you can calculate that 60,200 again using that second method by subtracting the rates. So if I take then the rate of the 0.612 minus the 0.602, multiplying that times the 100,000, there's that $1,000 once again. Now the is that we're now going to be collecting on the receivable. So now we have this receivable we paid off. Notice we paid off in the forward contract, the dollars payable here. Now we're going to be collecting on the receivable. Now when we collect on the receivable, we're going to be collecting the 100,000 Australian dollars, and then we're going to be recording that, of course, on the US dollar side. Now remember, as we do this, all the transactions that we've done thus far are included up here for year 2, including the current transaction that are included in the entries column here. So now we're going to say, all right, we're going to be receiving the currency. So we're going to be getting the foreign currency units. We're going to put that up top, the foreign currency units. It's kind of like cash. We're getting kind of cash, but we're getting Australian dollars. So we're getting Australian dollars, which is we're going to measure just like we measure anything else. We're going to say we got 100,000 Australian dollars, but we're going to measure it in US dollar terms, which we've accounted to be that 60,200, which again, if we were to calculate that, would be the 100,000 times the spot rate, which is 0.602, 60,200. So we're going to put that on the books at the 60,200, it representing the 100,000 Australian dollars we have received. Then on the other side of things, we have the receivable, which is the foreign currency receivable from the exchange broker that will go down. So this item goes down to 0 now. Again, we got paid $100,000, but we had revalued this receivable to the US dollar equivalent, and now we're going to take it down by the US dollar equivalent down to 0. So now we're holding on to our $100,000, which is represented by 60,200 US dollar measurement currency, and we're going to use it to pay off the payable that we have, which is $100,000 of Australian dollars, which of course the payable and the receivable are now equally valued because we've equally valued these 100,000 Australian dollars in terms of current US dollar amounts. All right, next item then. Then we have all these items, including the current item, are now already included in the entries column. And we're going to do the final step, which of course is just to pay off the payable, to pay off the $100,000. in Australian dollars. So we're paying off. Now we paid off the debt in Australian money. We paid off the 100,000. We record that on our books as a decrease in the units. So the 60,200 Australian units, measuring the 100,000 we paid in US dollars, now goes down. So recording that out, it goes down to zero. And then the other side is the payable, of course. The payable now goes down to zero. So the payable is now off the books as well. So end of the day, we've got the cash on the books now at this amount. We've got the foreign currency in units has now gone back down to zero. The foreign currency receivable from the exchange broker is now back down to zero. We have the depreciable asset on the books. It's on the books at the original time that we basically purchased the depreciable asset, even though we didn't purchase for cash, even though we had a payable. We recorded it at that beginning point and used that spot rate, the exchange rate at the point in time that the purchase took place, and that stayed where it was this whole time. So, and that happened back in, you'll recall, this transaction took place on 12/1. So we haven't adjusted this. The adjustments that we made for the currency changes have resulted in the gains and losses on the income statement rather than us revaluing the depreciable asset in any way since the point in time it was purchased. So then we have the accounts payable back down to zero, the dollars payable to the exchange broker back down to zero, retained earnings now reflecting the change. It was 100,000. It now reflects the changes that happened in year one for foreign currency gains and losses that rolled into retained earnings. And in the current year, year two, we see the current year gains and losses, which would of course affect the net income.